The market is not a chaotic environment driven solely by news or random events. It is a highly structured arena dominated by professional interests whose operations define the trajectory of price. The core objective of the professional operator is the efficient execution of massive transaction volume. This necessity dictates market behavior, compelling the professionals to actively seek out and utilize the liquidity generated by the protective orders of the public. This foundational understanding is encapsulated in the Wyckoff concept of the Composite Man, a singular conceptual entity representing the unified action of all major institutional, banking, and professional trading interests. This entity controls the supply and demand dynamics with deliberate intent. The Composite Man operates with a clear four-stage plan: accumulation, markup, distribution, and markdown. The transition between these major phases requires a period of consolidation, known as the trading range, where stock is systematically transferred from weak hands to strong hands, or vice versa. The critical insight is recognizing that these trading ranges are not periods of indecision. They are periods of strategic preparation. They are built specifically to obscure the professional activity while simultaneously building the necessary cause for the ensuing effect, utilizing the fundamental law of cause and effect. Before continuing, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this content to more people. The professional campaign requires fuel. That fuel is always liquidity. Liquidity manifests most reliably in the concentrated pools of protective stop orders placed by the general trading public. The public trader, following conventional technical analysis, places protective stop orders just below obvious support levels in an uptrend or just above obvious resistance levels in a downtrend. These predictable locations are precisely where the Composite Man focuses manipulative efforts. When the Composite Man is accumulating, the goal is to acquire a massive inventory of shares at the lowest possible price. To do this efficiently, the professional needs sellers willing to part with their stock. The most motivated sellers are those who are panicked out of their positions by a sudden, alarming price decline. Therefore, the Composite Man must engineer a price move that drives the market just far enough to trigger the resting sell stops below the established support. This manipulative event forces the weak holders to liquidate their positions at the exact moment the professional is ready to absorb the supply. This action is not malicious, it is structurally required. If the professional attempted to buy the full intended quantity without first clearing the existing supply through a shakeout, the buying pressure itself would drive the price up prematurely, forcing the professional to pay a higher average price. The professional must clear the path, the line of least resistance, before initiating a sustained markup. Clearing the path means systematically eliminating any floating supply that remains in the market. The elimination of supply is achieved by triggering those resting protective stop orders. Similarly, when the Composite Man is in the distribution phase, the goal is to sell off a massive inventory of shares at the highest possible price. To do this efficiently, the professional needs enthusiastic buyers. The professional must engineer a price move that drives the market just far enough above the established resistance level to trigger resting buy stop orders and attract new, excited demand. This manipulative move convinces the public that a powerful breakout is underway, leading them to eagerly step in and purchase the stock being offloaded by the Composite Man. The entire trading range structure is a complex mechanism designed to facilitate this transfer of ownership under the guise of market indecision. The Composite Man uses time and volatility to wear down the patience of the public, ensuring that when the manipulative move finally occurs, the emotional reaction is maximized. Wyckoff observed that the professional operation is characterized by four distinct phases within the consolidation range. Phase A marks the initial stopping of the previous trend. This is where the initial heavy lifting occurs, often marked by a selling climax in accumulation or a buying climax in distribution, followed by an automatic reaction. Phase B is the construction of the cause. This phase is typically long and tedious, characterized by numerous tests of the trading range boundaries. The Composite Man is systematically accumulating or distributing stock, absorbing or releasing supply and demand over an extended period. The boundaries of the range become well defined, making the protective stop placements of the public highly predictable. Phase C is the pivotal phase, where the stop hunt occurs. This is the structural necessity that clears the remaining supply or demand. This phase is the focus of the professional trader seeking confirmation of the coming trend. It involves the decisive, purposeful penetration of the established trading range boundaries. In accumulation, this Phase C event is known as the spring or the secondary test in Phase C. It is the final, deep penetration that captures the last pockets of supply. In distribution, this Phase C event is known as the Upthrust after distribution or the secondary test in Phase C. It is the final push that captures the last pockets of demand. These manipulative actions are essential because they achieve two critical objectives simultaneously. First, they provide the professional operator with the necessary volume to complete their position. Second, they establish a false sense of direction for the emotional public, trapping them on the wrong side of the impending major move. Understanding the predictability of human behavior is central to the Composite Man's strategy. Retail traders are often driven by fear and greed. When a support level breaks, fear dictates an immediate sale. When a resistance level breaks, greed dictates an immediate purchase. The Composite Man exploits these exact emotional reactions. The professional trader, utilizing the Wyckoff methodology, must separate emotion from observation. The break of support is not automatically a sign of weakness. It is, more often than not, a sign that the professional is executing a campaign to gather fuel. The key to interpreting these structural raids lies in recognizing the difference between a legitimate breakout and a manipulative shakeout. A legitimate breakout leading to a major trend occurs only after the Composite Man has successfully completed the accumulation or distribution process and has cleared the line of least resistance. The shakeout, conversely, is designed to fail immediately after achieving its liquidity objective. The price must quickly snap back into the established trading range, signaling that the supply that was triggered has been successfully absorbed by the professional interests. If the price breaks support and stays below support, the structure indicates a failure of the accumulation plan, and the Composite Man has retreated. If the price breaks resistance and stays above resistance, the structure indicates a failure of the distribution plan. But in the classic successful professional campaign, the price action is a trap. The Composite Man creates the illusion of breakdown or breakout, captures the necessary liquidity, and then immediately reverses the direction, leaving the public chasing the move or trapped in a losing position. The structural necessity of the stop hunt ensures that these patterns repeat across all time frames and all liquid markets. The professional trader understands that the market must move to predictable stop locations to gather the energy required for the next phase of the campaign. The entire process is governed by the law of effort versus result. If the Composite Man expends significant effort, evidenced by high volume, in penetrating a key level, but the result, the sustained price movement, does not follow, it is a strong indication that the effort was purely manipulative absorption, not the start of a genuine trend. This failure to follow through is the essential clue that the professional campaign is nearing its final stage of preparation. The professional trader must learn to read this structural language, recognizing that the momentary violation of a boundary is often the precursor to the greatest opportunity. The Composite Man is preparing to launch a sustained move, but only after the market has been thoroughly tested and cleaned of opposing supply or demand. The stop hunt is merely the most dramatic and visible part of this necessary cleaning process. The successful trader aligns with the Composite Man by anticipating where the liquidity lies and waiting patiently for the confirmation that the raid has been successful. This confirmation is the core element that separates the professional approach from the emotional trading habits of the public. The foundation of this strategy rests entirely on the recognition that volatility at the boundary of a trading range is typically engineered for transactional efficiency, not a spontaneous reflection of fundamental change. The professional manipulates the short-term price action to ensure the long-term trend can proceed unimpeded. This structural requirement means that the professional trader must shift focus from trading the obvious support and resistance lines to trading the failure of the market to sustain a break of those lines. This approach turns moments of public panic into moments of high probability opportunity. The professional trader knows that the Composite Man cannot afford to leave significant supply or demand floating just outside the trading range boundary. If the majority of the public's protective orders were left untriggered, those orders would later act as resistance or support against the intended markup or markdown, requiring the Composite Man to expend unnecessary capital defending the move. The efficiency of the campaign demands the elimination of these opposing forces before the markup or markdown begins. This elimination is the sole function of the manipulative shakeout in Phase C. Furthermore, the scale of the distribution or accumulation determines the intensity of the stop hunt required. If the professional has been building a position for many months, the final shakeout must be dramatic enough to reach the protective stops of even the most patient long-term investors who have been holding throughout the trading range. The composite man must ensure that the subsequent trend is driven by genuine market interest, not by the professional constantly having to absorb supply from those who were not shaken out. The goal is to establish the line of least resistance so thoroughly that the markup or markdown can proceed with minimal effort and maximum momentum. This understanding shifts the focus away from trying to predict the exact timing of the market turn and towards merely observing the professional's necessary preparation. The professional trader simply waits for the market to complete its cleaning operation. The core lesson of the Wyckoff method, particularly regarding these structural raids, is that apparent weakness or strength at the boundary of a trading range should be viewed with extreme skepticism. It is precisely when the market looks weakest, having broken support, that it is often strongest, having absorbed the last of the supply. Conversely, when the market looks strongest, having broken resistance, it is often weakest, having exhausted the last of the demand. The composite man uses the emotional bias of the public as the primary tool for transaction management. Recognizing this systematic exploitation is the first step toward mastering professional trading techniques. The following parts will detail how to technically identify these engineered moves and, most importantly, how to enter the market only after the trap has been sprung and confirmed. The technical identification of these engineered movements relies entirely on recognizing specific structural anomalies within the accumulation and distribution phases. The professional trader must move beyond simply labeling the structure and focus intensely on the character of the price action and the corresponding volume signature during the final shakeout. The composite man executes the most critical manipulative events during Phase C of the trading range schematic. This phase is the point of commitment, where the professional operator ensures the market is fully prepared for the ensuing trend. It is here that the final pools of liquidity are targeted and absorbed. In the context of accumulation, the primary manipulative event is the spring. The spring is a calculated maneuver where the price is driven temporarily below the established support level that has defined the trading range. Public traders who have entered long positions during the early stages of accumulation typically place their protective sell stop orders just beneath this perceived support. When the price breaks this level, these sell stops are triggered. Simultaneously, the break below support convinces short-term traders that the market is entering a new markdown phase, prompting them to initiate short positions. The professional operator acts as the massive buyer during this momentary panic, absorbing all the supply that is released by the stop orders and the new short sellers. The defining characteristic of a successful spring is the immediate and decisive reversal back up into the trading range. The penetration is brief, sharp, and quickly negated. The spring effectively achieves two goals for the composite man. First, it provides the necessary supply at lower prices to complete the accumulation campaign. Second, it traps the late short sellers who will now be forced to cover their positions, thereby adding fuel to the future markup. The corresponding manipulative event in a distribution structure is the upthrust. This maneuver occurs when the price is briefly driven above the established resistance level of the trading range. Just as in accumulation, public traders place their protective buy stop orders just above resistance, hoping to protect their short positions or to initiate new long positions on a perceived breakout. The upthrust triggers these buy stops and attracts breakout traders eager to participate in what they believe is a new uptrend. The composite man uses this surge in demand to offload the remainder of their holdings at elevated prices. The upthrust is the professional operator's final act of distribution before the markdown begins. A legitimate upthrust is also defined by its failure to hold the penetrated level. The price quickly reverses and closes back below the resistance, trapping the buyers who entered on the perceived breakout. These trapped buyers will become future sellers, adding to the downward momentum of the coming markdown. Technical analysis demands more than just recognizing the shape of the spring or the upthrust. The true confirmation of professional manipulation lies in the volume signature accompanying the penetration. When the price moves below support during a spring, the volume must be significantly higher than the average volume observed during the preceding trading range. High volume during the penetration confirms that a substantial transfer of ownership has occurred. The Composite Man was actively present, absorbing the supply. If the price penetrates support on low volume, it suggests a lack of interest and potentially a genuine, sustained breakdown rather than a manipulative raid. Conversely, during an upthrust, the penetration above resistance must also occur on high volume. This high volume confirms that the Composite Man successfully executed a large amount of selling into the public's eagerness to buy the breakout. High volume here validates that the professional unloading was efficient and complete. The reversal from the manipulative event must be swift. The price must immediately move back into the safety of the trading range, signaling that the move outside the boundaries was purely a temporary raid for liquidity and not a genuine shift in market structure. However, the professional trader does not commit capital immediately following the initial reversal from the spring or the upthrust. This immediate reaction is often volatile and still carries risk. The market must prove that the supply or demand absorbed during the manipulation has been fully cleared and that no residual forces remain to impede the intended trend. This proof is delivered by the secondary test. Following a successful spring, the market will almost invariably return to test the area near the low of the spring or the support level from which the spring initiated. This event is termed the secondary test of the spring. The professional operator is using this test to confirm that the supply absorbed during the initial manipulation is truly gone. If the price approaches the low of the spring and sellers reappear, the campaign is likely to fail and the market may genuinely break down. Therefore, the defining characteristic of a successful secondary test is the volume. The price drop during the secondary test must occur on significantly lower volume than the manipulative spring itself. Low volume on the secondary test is the ultimate confirmation signal. It indicates a lack of supply at that price level, meaning that the Composite Man successfully absorbed all the available stock during the initial raid. The professional path is clear. The market is now poised for the markup phase. If the secondary test occurs on high volume, it signals that supply is still present and the accumulation is not yet complete. In such a scenario, the professional trader must remain on the sidelines and wait for a true confirmation of supply exhaustion. The same principles apply to distribution and the secondary test following an upthrust. After the high-volume upthrust, the market will decline and then return to test the area near the high of the upthrust or the resistance level. This is the secondary test of the upthrust. The purpose of this test is to confirm that demand has been fully exhausted. If the price rises back toward the resistance level and encounters low volume, it confirms that there are no remaining buyers willing to absorb the distributed stock at elevated prices. The lack of demand is the confirmation that the markdown is imminent. If the secondary test of the upthrust occurs on high volume, it suggests that demand is still robust, and the Composite Man has not yet completed the full distribution campaign. Further sideways action or even a higher price thrust may be required to clear the remaining buyers. The location and character of the secondary test are often described using specific structural terms. In accumulation, the secondary test may manifest as a backup to the edge of the range, confirming the old resistance now acts as support. In distribution, it is often referred to as the last point of supply or last point of distribution, confirming the old support now acts as resistance before the decline. The timing of entry is determined by the successful completion of this test. The professional trader waits for the price to show weakness on the low-volume test and then begins positioning for the trend. It is crucial to understand the psychological difference between the manipulative event and the confirmation test. The spring and the upthrust are designed to generate maximum emotional response, fear in accumulation, euphoria in distribution, and thus they are high-volume events. The secondary test, conversely, is designed to confirm the absence of market participants at the critical level, and thus must be a low-volume affair, representing market quietude and lack of opposition. The structural relationship between the manipulative event and the secondary test provides the optimal entry location and risk definition. In accumulation, the ideal entry is near the low of the secondary test, with the protective stop order placed just beneath the absolute low established by the spring itself. This placement ensures that if the market breaks the spring low, the accumulation structure has failed entirely and the position must be exited with minimal loss. The distance between the entry point and the stop order defines the initial risk unit. In distribution, the ideal entry is near the high of the secondary test, with the protective stop order placed just above the absolute high established by the upthrust. If the price manages to break the high of the upthrust, the distribution structure has failed, and demand is proving stronger than anticipated. By waiting for the secondary test, the professional trader avoids the trap of reacting to volatility and instead enters the market based on clear evidence of supply or demand exhaustion. This methodical approach transforms a perceived moment of panic or excitement into a calculated high-probability entry point. The secondary test acts as the final gatekeeper, ensuring that the Composite Man has successfully cleared the path for the sustained markup or markdown. Trading without waiting for this confirmation is equivalent to entering a professional campaign before the professional itself has committed its full resources. Patience is the ultimate defense against professional manipulation, allowing the trader to turn the Composite Man's liquidity raid into a defined opportunity. The success of the entire campaign hinges on the quiet, low-volume confirmation provided by this final test of the market's conviction. The objective execution phase begins only after this confirmation is complete. The professional trader understands that entering a position immediately after a spring or an upthrust is premature. The true opportunity is found in the subsequent quiet period, the secondary test, which validates the structural integrity of the move. This waiting period is not passive, it is an active confirmation process. The trader requires evidence that the supply or demand that fueled the preceding manipulative action has been fully absorbed and cleared from the market. The low-volume signature of the secondary test provides this essential evidence, and if, after a spring, the market returns to the area of the previous low on heavy volume, it indicates that significant supply still exists. This means the Composite Man failed to absorb all the shares offered during the initial shakeout, and the market is not yet ready to ascend. Such a high-volume secondary test invalidates the entire accumulation schematic, suggesting further consolidation or a deeper decline is necessary. Conversely, a successful secondary test of the spring occurs when the market approaches the low or the support level and the trading volume dries up almost entirely. This lack of selling pressure confirms that the weak hands have been cleared and the professional operators now control the float. This is the moment when the market is poised to begin the markup phase. In distribution, the principle is reversed. Following an upthrust, the market must test the previous resistance area. If this secondary test occurs on high volume, it signals that renewed demand is entering the market, and the Composite Man has not yet successfully liquidated all their holdings. The structure remains unstable. However, if the secondary test of the upthrust shows extremely low volume, it confirms that demand has been exhausted. There are no longer enough committed buyers willing to absorb the professional selling pressure at that price level. The path for the markdown is clear. The entry strategy hinges entirely on this confirmation. The professional trader seeks to minimize initial risk by entering as close as possible to the point where the market proves its readiness. In accumulation, the ideal entry is placed near the low of the secondary test once the low-volume signature is firmly established. This offers the tightest protective stop placement possible relative to the anticipated move. The protective stop order is strategically placed just below the absolute low established by the spring itself. This placement is not arbitrary. It defines the point of failure for the entire accumulation structure. If the price returns to break the low of the spring, the Composite Man's campaign has failed, and the trader must immediately exit the position, preserving capital. In distribution, the entry is placed near the high of the secondary test, following the low-volume confirmation. The protective stop order is placed just above the absolute high established by the upthrust. If the price returns to break the upthrust high, it signals renewed buying power and invalidates the distribution analysis. By waiting for the secondary test, the trader ensures that the highest probability setup is utilized. The Composite Man has done the heavy lifting, the manipulation, the absorption, and the subsequent confirmation. The trader is simply capitalizing on the resulting market clarity. This patient approach drastically improves the potential reward-to-risk ratio. Since the entry is placed near the ultimate low of the range after accumulation, or the ultimate high after distribution, the distance to the protective stop is small, while the potential distance to the final price target is substantial. The final element of professional execution involves projecting the potential price target. Trading without a calculated objective transforms a business operation into a gamble. The Wyckoff method provides a rigorous structural framework for projecting price movements based on the energy built up during the consolidation phase. This projection relies on point and figure charting techniques. The underlying principle is simple. The cause must equal the effect. The energy expended by the Composite Man to accumulate shares, the cause, must result in a proportionate move upward, the effect. Similarly, the time and effort spent distributing shares must result in an equivalent markdown. The projection process involves counting the horizontal distance of the trading range, typically measured from the start of Phase A through the conclusion of Phase C. This horizontal count, when translated into vertical price units using the scaling of the point and figure chart, provides the minimum, intermediate, and maximum price objectives for the subsequent trend. For instance, a prolonged accumulation range that spans 3 months and generates a horizontal count equivalent to 200 points suggests a significantly larger markup potential than a structure that consolidates for only 3 weeks and generates a count of 20 points. The size of the consolidation reflects the conviction and commitment of the Composite Man. Professional trading demands that the protective stop order and the price target be determined before the entry order is executed. This pre-planning removes emotional decision-making from the trade management process. The trader knows precisely where the position will be closed for a loss and where it will be closed for a profit, adhering strictly to the calculated risk parameters. The entire process of trading the confirmation, waiting for the secondary test, defining the stop and projecting the target, is a testament to the fact that success in the market is not about predicting the news or reacting to emotional volatility. It is about objective analysis of supply and demand as evidenced by price and volume. When the market executes a spring, the public trader sees fear and exits their position at the worst possible moment. The professional trader sees opportunity, but exercises patience, waiting for the subsequent quiet test. This psychological difference is the single greatest determinant of long-term success. The trader must learn to view the market through the lens of the Composite Man, understanding that every manipulative move is designed to harvest liquidity. By refusing to participate in the panic selling or the euphoric buying that accompanies these raids, and by instead focusing only on the structural confirmation, the trader aligns their actions with the professional cycle of the market. This disciplined approach transforms trading from speculative gambling into a rigorous, rule-based business. The mastery of this business requires more than just pattern recognition. It demands psychological fortitude and an absolute commitment to capital preservation. The professional trader understands that their primary duty is not to make money, but rather to protect the capital they already possess. This perspective dictates a mandatory use of protective stop orders, ensuring that any analytical error results only in a small predetermined loss, never a catastrophic drawdown. The fatal error of the inexperienced trader is the emotional attachment to a position, often leading to the disastrous practice of averaging down a losing trade. The Composite Man relies on this emotional vulnerability. The Wyckoff methodology provides the antidote, a clear, objective framework where price action, not hope or fear, dictates the course of action. The concepts discussed here, the necessity of the protective stop order, the focus on price and volume action over external news or tips, and the psychological discipline required to wait for the highest probability entry are foundational pillars of successful market operation. These disciplines were codified by Richard Wyckoff himself, who dedicated his career to teaching that trading must be treated as a serious intellectual business endeavor. The principles of waiting for confirmation and rigorously limiting risk are not merely technical rules. They are integral parts of a complete business philosophy designed for capital preservation and systematic growth. Wyckoff's foundational text, How I Trade and Invest in Stocks and Bonds, is not a general guide to wealth management, but a profound manifesto on the business of speculation. It details the precise methods by which a trader must operate to compete successfully against the professional operators. It emphasizes that success is built on the strict avoidance of the common psychological traps that ensnare the public. For the serious individual seeking to elevate their market operations from speculation to a professional pursuit, the detailed explanations of why mandatory stop orders are essential, why ignoring outside news and tips is crucial, and how to maintain the psychological edge necessary to wait for the quiet confirmation of the secondary test are indispensable. Understanding the technical mechanics of the spring and the upthrust is only half the battle. Mastering the business discipline required to execute those trades is the other half. The comprehensive framework for treating trading as a business, focusing on capital preservation and utilizing objective technical analysis over emotional impulses, is detailed thoroughly within his work. Resources for furthering the study of these specific Wyckoff principles, including the foundational text, are available via the links provided in the description below. Mastery of the market begins with mastery of self and the adoption of a professional methodology.